Jamal, in Vancouver and British Columbia, as we know, real estate is always a big topic. How do real estate owners take advantage of whole life insurance?
That's a great question. I have a lot of clients in this situation who purchased real estate 10, 15, 20 years ago, and the property values have appreciated so much to the original purchase price of the property. There's going to be a big capital gains tax on death for people in this situation. So when there's a husband and wife, when one of them passes away, there's no tax consequences. But when the second spouse passes away, the CRA basically says everything is deemed sold and taxes are due on everything except your primary residence and your tax-free savings account. So if you have a lot of real estate, which is an asset that doesn't have any liquidity, where do you get the money to pay the taxes? This creates a problem for the beneficiaries of the estate.
Can you tell me about a client you helped recently with this particular situation?
Absolutely. I have helped about a year ago 2 investors who were in their late 60s that had purchased property and farmland in Nanaimo. They own storage warehouses and some residential properties, and they started acquiring these assets in the late 80s. So they acquired them for very, very low prices, and those properties have accumulated and appreciated into the tens of millions of dollars. So working with their accountant, we figured out that their tax bill was going to be about $7 to $8 million, and they had almost no liquidity within their portfolio. It was pretty much all real estate based. So when you pass away, where do you come up with $7 million to pay your taxes? It's a good problem to have, but it's a problem nonetheless. So if they did nothing, they would basically have to sell their real estate. The children, when they inherit this real estate, would have to sell it within 9 months approximately to pay the tax bill.
That's option one, not so great, selling the real estate to pay the tax bill. Is there an option two?
Yeah, so option one is a forced sale after death to pay the property, probably not at market value prices because it's an estate sale, so you're forced to sell it to come up with the proceeds. You can sell some of the property while you're still alive. That way you ensure that you're getting at least market value because it's not a forced sale. And then you can take those funds and then you have those funds available to pay the taxes. That would be a better strategy. Still not the best strategy.
Option two, which is selling a portion of your real estate to prepare for the pending tax bill, also doesn't sound so great. Is there an option three?
Yeah, there is. The third option is you can go to your bank, whichever bank you're dealing with that's provided, the mortgages and the loans to purchase this real estate, and you can ask them for a loan while you're alive that would pay off your tax bill. That's better than having to sell the real estate, because if your real estate is going up in value more than what the interest rate the bank is charging you on the loan, then you're ahead. You're still growing your wealth. It's not easy though to get a loan of this nature for most banks. Secondly, when you pass away, there's an outstanding loan now that needs to be paid.
Option three also does not sound that great. I've got to go to the bank, as you say, get a loan, and now I'm also saddled with a loan debt that somebody has to pay at some point as well. Let me guess, option four is where whole life insurance comes into play and provides the best alternative to this situation.
You got it. So in the case of my clients, 90% of their portfolio was sitting in real estate, but they did have about $2 million that was sitting in a GIC. That GIC was not earning much at the time because interest rates a few years ago were quite low. So we redeployed that $2 million over a period of 7 years into the whole life insurance plan. We immediately bumped up the return that they were getting on the GIC. So even if you look at nothing else, they're just getting a better return. But two, we created a substantial death benefit as well that's going to be used to pay off a portion of their taxes as well.
So in option 4, with the whole life insurance policy, How much did they save in the tax?
So in option 1, they would have paid $7 million in tax. Using the whole life insurance plan, the death benefit is going to be about $5 million. They were using money that was already sitting at the bank, not doing anything. So we've saved them about $5 million in tax using this strategy.